So we're going to get started. I want to thank everybody for taking time out of your busy schedules to spend a little bit of it with us at Flock today. We've been working on our seed planting series since last quarter, and we have really recognized over time that a lot of folks look to us for real estate sales guidance and tips and advice. And even though we're in the property management space, we decided that we actually do have a lot of tips and guidelines and guidance for folks that are interested in moving from the rental space into the homeowner space. And we want to give you as much of that information as we possibly can. And the nice thing about it is that we will say we don't really have any feather in this flight. We don't do sales, and this is just a really neutral space to ask as many questions as you'd like, and for us to be able to give you as much guidance as possible from kind of a management perspective and understanding and the nuances of the DC market. And I'll start by saying that we do focus on Washington, DC proper, and so some of the background and information we're going to offer is really specific to Washington, DC. But in terms of being an informed home buyer, all of these guidelines that we're going to give you and areas that we'll cover are pretty applicable to being a sophisticated buyer in any marketplace. Obviously, it's a really tricky time to navigate the world and to navigate real estate, and so hopefully you'll get a chance to have your questions answered. We'll walk through this presentation, and then we're going to go ahead and take questions at the end. Some folks were able to submit those questions ahead of time, and we'll prompt ourselves to answer those, but if something else comes up, please don't hesitate to drop it into the chat, and we'll look forward to kind of guiding you through any information we have. Walk you through our agenda, but first I want to introduce the folks that are going to be on this call with me. We've got Steph Whitco, who's our Nest Senior Vice President. She is the one that really understands kind of the pulse of how rentals work in our marketplace and kind of what's at play. And we're going to talk a little bit about if one of your home purchase objectives is to buy a rental, we're going to talk a lot about that today. Chelsea and Jason are both leads in our Roost DC space. We manage condo associations and co-ops in the city. And then we've got Pavan Kupchandani, who is our general counsel and has a really strong understanding of what all the kind of regulatory issues are that you want to be aware of as a buyer. And he's also an owner investor, which I think he can give you some first person perspective on what to expect as a buyer. So I'm going to walk through the agenda now. What we're going to do is kind of talk about what your different options are for a target purchase. So do you want to buy a house? Do you want to buy a condo? Do you want to buy a co-op? That's its own category of buying, and they're all quite different, and they're all going to have different performance over time. So we'll talk about that for a few minutes. And we're going to talk about, what does it take to prepare yourself to be an eligible and, desirable buyer, both from a seller's perspective and a lender's perspective. And that's about kind of getting your financial house in order and then thinking about what you want to buy. There's nothing worse than having, big eyes and a small stomach. So that's even harder in a real estate environment than it is when you're out to dinner, because it can get discouraging when what you want isn't what you can afford, or when you're not prepared for that purchase. Then we're going to talk a little bit about where to buy. We're not going to give you neighborhoods specifically, and we're not going to steer you into thinking one neighborhood is better than another, but we can speak to what's more popular and what to factor in when you're shopping for homes, and where you either want to see yourself living for a period of time, or where you might want to see residents that you might rent to over a period of time. And again, we'll keep revisiting the same theme, which is you really want to think a lot about how long you're planning to hold the property and live in it. Is it 2 years? Is it 3 years? Is it 5 or 10? And the questions that you want to ask will change over time depending on how long you want to hold that asset. We're going to talk about who you need on your side to make sure that you can get through your purchase process, from inspectors to lenders to real estate agents, and making sure that as you walk into the transaction, you have a sophisticated, smart team on your side to make sure that you've got a good advocate and you're making measured, informed choices about what you want to do in terms of this big purchase that you'll make. I'll sort of underscore that anybody that works for you in your transaction should want you to get the right property for you. And you should never feel pressured to buy something if it doesn't feel like a good fit. And finally, we'll talk about, what happens once you've made the offer. How do you manage that due diligence? And then what do you do with your asset once you own it? So most people don't buy their forever home. That's kind of in some ways a thing of the past. It's not necessarily out of the realm of possibilities, but most people buy homes or properties that they'll live in for a period of time, and then they'll plan to move on from those. So you want to think not just about how you're going to use it today, but what the future holds for that property. So I'm going to go over the different types of real estate that you can consider and some trends that we're seeing in the DC specific market. So first of all, you want to think about what makes sense for your purchase. And some folks can be flexible and others can't, right? So if you have a family and or your family's growing and you need to be really thoughtful about school districts or backyards or walkability, all of those are going to factor into the decision-making lens that you have to work with. Right now, houses, as you can all imagine, and as we've all seen in the news, are sort of flying off the shelves, particularly in this region and area. Space is certainly something we can all really covet right now. When it's in our home space, we want to make sure we have as much as possible, because so many of us are spending much more time in our homes than we've ever spent in the past. So things like second bedrooms, backyards, even pools are very popular, things that some buyers might have shied away from, like a swimming pool, because they're a lot of work and they can be a liability. In fact, folks are really seeing that as a plus. Parking, garages, backyards with swing sets, things that can grow with you and your family. We're seeing record prices in the housing proper market, meaning like single family homes, moving very quickly. Overall in the DC marketplace, we're seeing that homes are inching north of $1 million in terms of their value, which I think is, on one hand, that can be considered a good thing, and on the other hand, it can be considered a real challenging thing for people that are trying to get in the market. It's getting harder and harder, which is hard to see. We're also seeing interest rates at historic lows, and we're not actually going to see that change for some time. You'll see some variation, but not a lot. And I think that encourages more folks to get into the market than they might have in the past, because basically the cost of buying home is going down, even if the cost of the home is actually going up. So they're sort of evening each other out, which makes it easier for sellers to justify a higher purchase price, because the interest rates allow you to buy more than you might have if they were a little bit higher. So someone's benefiting from that. It's probably a lot of mortgage lenders as well, who are very busy. So you want to get on someone's dance card early if you're buying, so that you're not feeling rushed. A lot of sellers are really invested in the transaction happening quickly. So most of those mortgage agents are really bogged down. So you want to be sure that you have a relationship with one that can move quickly for you. So obviously we know houses are going to be really popular. They're going to have a lot of different value and perk right now. But condos and co-ops are very popular, and certainly part of our inventory in Washington, D.C., and are also performing well. We're seeing condos specifically in newer communities, and new condos moving more quickly in the sales arena than older condos. So if you've got an older established neighborhood with an older established condo unit, those are performing less well than new buildings and neighborhoods that might not have been as popular in the past. So some of those neighborhoods might include Brightwood or Petworth, or areas that may not have been considered as walkable or as pedestrian, but as people's lives and lifestyles have changed, I think different neighborhoods and expectations have shifted a little bit in terms of what buyers are interested in considering. And so that will be a factor as well. And I think for many reasons, people aren't interested in buying homes that need a lot of work. It's hard to navigate having work done in a non-pandemic era, and to kind of factor in sorting out and inviting folks into your home to work on them is a little bit harder now than ever. To wrap your brain around, and that's another cost center. You're not always able to gauge with a lot of predictability what it will cost to get that space into sort of the perfect condition for you. And so I think turnkey new spaces should hold a lot of appeal in that sense. Overall market trends, December sales in 2020 and for the month were a little bit lower than they had been in previous months for the year, but year over year, December of 2019 had sales that were 21.4% lower than 2020. So we see a lot of activity in the marketplace right now, much more so than we had in previous years. The median sales price in the district is $613,000. And as the urban turf, which is consistently solid source of information about market trends in Washington, D.C., that winter is the new spring, and springtime in Washington, D.C. has always been traditionally the hottest time in the market. We usually start to see people prep for that in February, aiming to get units up on the market and listed sometime in March, with things like really sort of on fire and until June, July, and then the market will start to pick up again after Labor Day. But we've sort of seen that kind of activity throughout the year and don't necessarily see that changing. By comparison, and because this is the space that we're most in tune with in terms of properties, rents are declining across the region, maybe a little bit less so in the single family home for the same reasons as sales are so high in that category. Rents are declining in the condo and multifamily housing environment, and that is because, as you'll guess, people are leaving the region. We have a lot of people that are moving home with parents and families because there's an economy there, and just more security and safety and certainty when there's so much that's uncertain at this time. We can't predict with any certainty whether we'll see people roaring back into the city, but we will be able to determine trends month over month as we see folks coming back to the environment for a Biden administration. I don't know if folks read The Atlantic. I keep trying to remind myself I shouldn't, but I do. It reads so good. But this prediction that cities and urban cores like Los Angeles, San Francisco, New York will sort of lose their appeal because the workforce is becoming more portable, and there is opportunity for the middle states to enjoy more robust corporate activity, and so we may not see properties values soar the way that we have. But I do think that, as with all things, Washington, D.C. seems to not necessarily be on the same path of trends. So because we host the federal government, and because despite the Trump administration working to move some of those agencies away from the DC area, we still host the power center for the United States and much of the world, and there will always be a strong need for housing in this area, whether it be short or very long term. And so I think that will bode well for anyone with property. But of course, we don't have a crystal ball, but it is something that separates us from a lot of the other urban cores. So I'm going to hand it to Chelsea now. Thanks, Chelsea.
Hi there, good evening, and thank you all for joining. Really great to see everyone. I'm going to be talking a little bit about your target purchase, and at the top, Lisa talked about how important it is to think about your plan, your 2 to 3, which is sort of the immediate plan, to 5 and 10 years, and how you're going to be using the space is critically important to starting to think about where you might be targeting your research when you start looking at property. Obviously, houses are much larger. There's more autonomy. You have the ability to do things to the outside of the home, as well as obviously in the inside. But with that comes a higher price tag, potentially higher maintenance costs, and having to deal with neighbors if you have a shared roof system, or what's called a party wall between 2 homes, and having to deal with maintenance of that. Obviously, it's more vulnerable if there's a natural disaster and your home gets wiped out because of a flood or a tree coming through the roof, then your whole asset could be tied up in sort of those repairs. But on the flip side, it does retain value and appreciates a lot faster and much more long-term than perhaps a condo or a co-op. We always mention that new construction, while it might be beautiful, sometimes it's not done in the best way. We all know the horror stories. And so if you are thinking about looking at homes and condos that are new, that to spend some time and to really understand who the developer is, who the construction team was that built it, so that it's not just the lipstick. They didn't just put some really lovely paint on the walls and slap some tile up, and you still have really bad electrical system or water system in your home, whether it's a condo or a house. But then there's also really beautiful homes that are coming online that people care about and took care of, and may have been part of a flip, but there was care. So just enter that market with some research behind you and some supports in that regard. For Roost DC, we manage condos and co-ops, and so we know these in and out. We understand the pitfalls and the benefits of both of these types of properties. Condos and co-ops are often much cheaper, as Lisa said earlier, in terms of their median price point. There is decreased maintenance needs. So if you're worried about that budgeting item, it may be a little bit easier to stomach that maintenance needs. However, you do need to think about the condo fees or the co-op fees that are tied with your home. My community in Southwest, my condo fees are pretty high because I have full service management and maintenance and things that are taken care of. Other communities have much lower. So it's something you have to think about, and also know that it will almost always increase, and there's always an opportunity for a special assessment. Frankly, some of our communities are facing some really dire financial decision making in terms of maintenance and repair, and having to pass special assessments to their community members that are significant lifts. And during our pandemic, when folks are having to make those tough decisions, it's not something that we enjoy, nor do the boards that we work with enjoy, but it is necessary to maintain that community and that building. So if you're thinking about what does it cost to own a condo versus co-op, you have to sort of put that in the back of your mind as you're looking at the budget and those governing documents. And then again, new construction, we know that new construction is moving much faster on the market. It seems to be staying on, they seem to be moving very quickly. I think people are really excited about having something brand new, but that doesn't always mean it's the best. Sometimes the older the building, their problems have already presented themselves, and either there's a plan in place or what we're walking into. So something to think about when you're looking at specifically condos. For cooperatives in the city, there's not as many, obviously, as condos or even other cities like New York. So there's fewer comparisons to be made. And there's a different governing structure. So you're actually purchasing a share or shares in a cooperative that entitle you to use the space, which means you lose a lot of autonomy. You may not be able to do a home renovation in your co-op if you want. The board may decide that that's not appropriate, and you can't move your toilet to the left wall versus the right wall. And they also have potentially stricter rules regarding usage. So if you want to buy and you're thinking about renting in 2 years, a co-op might not be the best fit. They may not allow you to rent, or may charge you a pretty significant fee over and above your carrying charges. So that's something to think about in terms of your usage. And then just generally, this is anecdotal, but the buildings are a little bit harder there are fewer lenders that are familiar with co-ops, and so they can be harder to finance. So if you're narrowing your availability of lenders, that can help you if you decide to go with a co-op. And the number of management companies that are able to successfully manage co-ops in the city are few and far between. And so there's always the risk of a board. If you get involved as the board, you might be running a small community that you hadn't planned on. And so something to think about as you are looking and comparing between house, condos, and co-ops. But all of them are great. They're great for what they're made for. And so we always encourage you to think about, again, what is your immediate usage? How long do you think you're going to be there? And if 3 years from now you want to move out, are you going to rent or sell? That may guide your decision making. And with that, in order to buy one of those things, you have to think about your financial money. So we're going to hand that over to my teammate. I think Jason. Sorry. No, back to Lisa. Sorry.
I think that's me. No, it's fine. I always get to talk about the money because my last name's Wise. All right. So, you want to make sure that your financial house is in order to get into a house. That's kind of the sum of the game. And so the best strategy before you start shopping is to see what you can afford. Almost every lender in the region will walk you through what you qualify for. And what they're going to do is take a handful of details from you, which would include basically what are your assets, meaning how much cash do you have, retirement, do you have any other things that you consider putting on a balance sheet, and then what do you owe, from student loans to other homes that you may own to other debts that you may be responsible for, like credit card debt. They're going to do the math and look at your income and decide basically what your upper limit is and what you can afford. I'll offer that they don't do a ton of due diligence there, which means that it's possible that you get a pre-approval note for a letter for $1 million. And then when they really start doing some digging, they find that you have like a zinger of a library late fee that kind of ruined your credit, and suddenly it's going to be a little bit trickier to get that loan. So keep that in mind, that a pre-approval letter doesn't mean you're approved. It means they're guessing based on a handful of details that you should be okay up to a certain amount. Both your real estate agent from the buyer side and the seller side are going to be expecting that you have that letter handled. And you want to factor in like all the costs of buying a home. So you want to factor in the principal amount that you're going to pay in the mortgage, the interest, the taxes, and the insurance as just the baseline operating costs, or not operating costs, but just the cost to be in that home. And if you can't put 20% down, you will be in a category of having to pay private mortgage insurance, which is basically you buying insurance to protect the lender from you, which I don't care for in principle, but it's unavoidable, and it can add up. So you want to be thoughtful about how much you can put down to sort of reduce that amount if possible. You can refinance out of it later, and there are ways of working around it, but it's something you want to be thoughtful about. And the pre-approval letter will probably not factor in what that private mortgage insurance will look like. You also want to just get familiar with the different programs that might exist. There are different programs that will help people with either down payment support, or there are affordable dwelling units, which are basically programs where developers reach agreements with the city to offer a certain number of affordable units that have fairly high income thresholds for qualifying. And so it's important to see what's available out there from a support perspective. And there are different programs that are really established to help people get into the home buying market. And make sure that you're not stretching. So the worst possible scenario is for you to buy more house than you can afford. And buying a house doesn't mean you can afford the mortgage. You have to factor in repairs, you want to factor in utilities, you want to factor in higher transportation costs. If you have a lawn, you need to make sure it's mowed. If you have snow, you have to make sure you're shoveling it, which means you need a shovel, which means you need salt, which means, you know, owning a home can be at a higher cost, and that's okay. You just want to make sure you're leaving room in your budget for all those factors. And again, as Chelsea mentioned in the last slide, you want to be aware of and eyes wide open when it comes to the finances for the condo or the cooperative that you're buying into, and recognize that there will be a year-over-year increase in those fees. And if there isn't, you should be worried about the financial management of that building, because just like your household budget needs to expand each year to accommodate inflation and other costs of living, the same is true for that building. Is going to need to, they're going to see the higher costs of operations for that building. And so we'll go to the next slide, which will tell me what's on it. So things that you want to factor in for a house are all those different costs. So pest control, landscaping, snow, roof repairs. Furniture is expensive. So if you go from a 1-bedroom to a 3, you know, I hope you have a lot of good friends that have some furniture if you don't have a budget for that furniture. So you want to think through like what it's going to take for you to be in the home in the way that you want to be in that home. And more space is more expensive. Condos, again, the condo fees and assessments can change over time, and there will be repairs, but you should sort of assume that each year you're going to have $1,000 to $3,000 in repairs that will be needed. For a house, we suggest saving like $500 or $600 a month in anticipated events, from an appliance going bad to an HVAC system needing to be repaired. And you might sail through a year without anything, but the next year you might have something bigger. So consider that as an escrow. You know, a roof replacement could be anywhere from $10,000 to $20,000, which we'll talk about in a minute. But you want to be really thoughtful about what you're inspecting and not waive those inspections, which you can get sort of inspired to do by some folks, but it's not worth it. You can do an info-only inspection, but you want to go into the property with as much information as possible so you can plan for the expenses of that. Co-ops are you know, their own little animal. Most cooperative, the buy-in cost is pretty low, so you might see a 1-bedroom that looks really, you know, attractive from a sales price. It might be in like you know, $200,000 for a very spacious 1930s great co-op building in Upper Northwest. That's where a lot of these co-ops are sort of tucked into those neighborhoods. They're roomy and nice, and you know, on tree-lined streets and the rest. But then you'll have an $800 co-op fee. That's not uncommon, and keep in mind that they tend to be more restrictive with use, but the condo and the co-op fees for co-ops tend to include more things, including oftentimes gas, sometimes electric, and your property taxes, along with the master insurance. So there is more bundled into that fee which can be an advantage. But just like a condo, you're going to start to see those fees go up a little bit. And the politics in co-ops are very interesting. So there's a different sort of relationship to the building that tends to unfold in cooperatives. And I think, and if you are looking at a cooperative, if you feel like that's something you want to buy into, and I don't think it's a bad idea by any stretch, you want to make sure that your lender is comfortable lending in a cooperative environment. There are only a handful of lenders that do work on cooperatives because they're just more complicated. Cooperatives own the property, which means they can oftentimes have mortgages against the property. And so it's just a more financially complex transaction. And so that is my tip on getting your financial house in order. And check your credit. Just kind of know what your credit is, know what you can afford, go in with as much information as possible. And I'm going to pass it on to Steph, who's going to talk about knowledge and power.
I think this one is Jason.
Oh, Jason.
Thanks, Lisa. Appreciate that. So let's talk about that twilight period between the contract being submitted and before you get to the settlement table. So there's several items that you want to get yourself familiar with, and we're going to deep dive into one regarding the seller disclosure packets, but there's a couple that we want to run through in terms of bullet point fashion. So first is understanding the full expense of the purchase that you're about to make. That's not just limited to the sales price of the condo or the single family home or townhome that you're going to purchase. That's the closing costs as well. One thing to note in DC, our transfer taxes are a little bit higher, ranging between 1.1 to 1.5%. So understanding the full scope of the cost outside of just the mortgage that you're going to have or the condo fees is critical to understand the upfront investment that you're going to make. Lisa mentioned a little bit about professional inspection. I'm not going to talk one way or the other about whether that's a value or not value, but that's something you as an individual looking at the asset in terms of its age, the visual conditions that you're seeing on it to make a decision as to whether or not you want to proceed with that professional inspection, have somebody take a look at it, give you somewhat of a baseline understanding of the deficiencies or issues that you may be running into, or you may not have seen as you're touring the property, and imagine yourself in there versus getting to some of the legwork of owning property. I'm going to skip over the review of the seller disclosure just because we're going to go into that in a little bit more detail into the next slide, but you will be presented with what is called the disclosure or the resale package that talks about for HOAs or any common interest community, the covenants, conditions, and restrictions that are applied to the property, the operation of the association, which all really is encompassing of that master deed in terms of restrictions on your bundle of rights. You're going to consider your operating costs as well. So once you've picked the home, seeing its size, a very large 6,000 foot square home is certainly a lot more expensive to heat than a 600 square foot apartment. So understanding your utility costs and your outlays, understanding the warranties and systems that make up that property. If you have a new roof, that's been put on the property, let's say within the last 2 to 3 years, making sure they get a copy of the warranty from the vendor for your records so that you know what workmanship or material warranties may or may not be available to you as you're residing in the property. And as you're looking at the condition in the property, as well as any information that you get from a professional inspection, that's where you're setting up the negotiation that you and the seller would have in terms of what expenses you're willing to outlay for any repairs to make the property ready for you, or what you're looking for the seller to provide for you prior to the transfer of ownership. And this all kind of comes into a judgment as you look into this negotiation, the pros and cons. Is the property the dream that you wanted? Is it in the neighborhood that you're looking for? Is it the community that you wanted to be a part in, making those judgments in terms of what they are willing to provide or not provide in terms of concessions on the contract, as well as that mortgage rate as well. Lisa talked about the costs associated, not just being the flatline mortgage, homeowners insurance, or condo fees that you have, but the maintenance and the upkeep, and making sure that you're not hitting the top line of your budget and you're allowing yourself some wiggle room for the unexpected, the oops, the leaks that happen in the middle of the night, and having a reasonable understanding of what those repairs are going to be. Let's deep dive a little bit in the next slide when we talk about the resale package, which I can speak ad nauseum about as an HOA manager. So the meat and potatoes in terms of the encumbrances that are going to you're going to experience as a unit owner with respect to your tenure in the property is going to come from what we call the Declaration of Covenants, Conditions, and Restrictions, which is also referred to as the master deed. These documents outline what you can and can't do with the property. So if you, or in condos specifically defining what is in or out in terms of your responsibility for maintenance, i.e. you may be responsible for the plumbing line up to the common, and any damages or any work that occurs or leaks that happen would be your responsibility, but you may not be responsible for the roof. That's over your section of the property. So having an understanding of what you're responsible for, as well as those use restrictions, are critical for at least getting the baseline for orienting yourself to the property. You also need to find the truth in the numbers as well, looking at the board's budgets, looking at their financial statements and their reserve study to understand the health of the association. That's going to give you a little bit of a temperature check as to whether or not there are special assessments that may be coming down the line, looking at the board meeting minutes to look for issues that the association has been discussing, projects that they have coming up. These are certainly more public entities, so they have meeting minutes that should be produced and available for your review so you can understand what business the association is having. And that's also going to lay out where your money is going as well. We hear a lot of homeowners talk about, well, what am I getting for my money in terms of the condo fee? So having an understanding of the amenities that you have, the services, whether that's a management company or a trash company that's coming out and providing you service for removal, electricity or water, if that's included in the overall cost of the property. Certainly knowing where those fees are going is going to pop up in your financial statement. So I always recommend looking at the income and expense statement as a starting point, and it should give you that kind of a little peek behind the curtain in terms of how the association is operating. And then lastly, before we switch it over to Pavan, again, I go back to understanding your responsibilities as a unit owner. Taking that time to go through the section regarding use restrictions is where I would start, understanding whether or not you're limited into the number of pets that you have, understanding if there's requirements for carpet coverings or other small things that you need to do in your unit to prevent any noise or further disturbances, but really getting not just an understanding of what it is that you're purchasing with respect to the physical asset, but the organization that is the homeowner or the unit owners association and how it operates. And with that said, I'm going to pass it over to my colleague Pavan to talk a little bit about investing. And thank you all for joining.
Thanks so much, Jason. Yeah, I wanted to just talk a little bit about, Lisa talked at the beginning about playing, Chelsea, we talked a lot about the plan, right? Home sweet home today, but then what? I talked to a lot of people that when they say forever home, they mean forever while my kids are still living at home. Well, no, but when they go to college, I'm gonna move. So it's absolutely true that a forever home doesn't always mean a forever home. A condo that you think that you're going to live in, I'll take an example. And the reason why I feel qualified to sort of talk about this is that I've been through a lot of these different places. I owned a co-op before I got married. My wife had a condo. It was a condo conversion that she owned before we got married. Together, we bought a condo in DC. When we got married, we bought a house. And so we're not quite at the kids out of the house yet, not quite, not even close. But all of the mistakes that we've talked about that my colleagues have, I've made them all. Okay. I didn't talk to when I was buying my co-op, I didn't talk to my pre-qual lender close enough to confirm that he actually could lend to co-ops. So when I went to write the contract on the co-op and I submitted the letter, they looked at it and they said, no, we can't take this. Your lender doesn't lend to co-ops. And it was a big rush and a big hassle and it was a big whatever, right? I didn't have the information. I didn't know there was that only certain lenders lend to co-ops. And by the way, you know what, that co-op, it was great. It did have the HVAC was paid for, the taxes were paid for, a lot of stuff was paid for. There's an on-site manager. They would come and fix stuff that when it was broken. It was great. Guess what? The building's on a land lease, and the land lease expires in 2052. And guess what? You have nothing when the land lease expires. I didn't know at that time to look, and I've since gone back and looked at the documents. And yeah, and it was all there in the documents. So case in point to what Jason's talking about, that did you say Twilight Zone? I don't think you said Twilight Zone, but you.
Twilight.
The Twilight. It is kind of like the Twilight Zone, because you know what? You're gonna get a big thick thing of documents, and you're gonna get sometimes 3 days to review them, and you're like, I can't even read these. And you really should. Another example is my wife bought a condo, a conversion. And so what that is it was a big building. It was an apartment for a long time. And at some point in time, they converted the apartment building to a condo building. They do a real good job with backsplashes. I got to tell you, they use the best paint. I got to tell you. You know what they didn't do? They didn't do anything to the like 80-year-old brick that in the entire building. And after we moved in, we realized the entire building had to be repointed. And while they're doing that, the balconies had to be worked on. And guess what? It was a $20,000 special assessment, and it was like a 100-unit building. And oh, by the way, you have 45 days to pay the $20,000. So had I known to ask, Jason mentioned a reserve study. A reserve study is something that a building does that says, that tells what the condition of the building. Had I known to ask for that reserve study, I would have seen the reserve study. And would I have known that this was coming or not coming? I don't know, but maybe that reserve study said something about this. The more you can read, the more documents you can get. And I think that's one of the big takeaways here. The more information you can get, the better it's going to be. But you know what? That first condo is going to, for me at least, and it's very possible, it could turn into an investment property. Okay, so let's think about when I bought when we got our second condo, we bought it. It was a 2-bedroom, 2-bath condo, and we bought it because it was roommate style. So there was one, the primary bedroom was on one side, the living room in the middle, and then another bedroom. To me, I think that's more conducive to roommates for a lot of different reasons. And guess what? We thought that we were going to live in that. And then when we had a kid, we could still live in it, still live in our urban area. My wife got pregnant and she was like, the walls are too thin. If one person complains when my baby is crying, I will lose it. So we're moving. That wasn't expected. There was a plan to stay in that condo, but you know what? Things change, and things are always going to change. Jobs are going to change. Lifestyle choices are going to change. You may need to be in a wheelchair. I mean, you just never know. And I think that if we had to sell at the point where we moved out of there, it was a little bit of a low market. We ended up renting it out, and it worked out well for us. I think because we thought and we planned ahead a little bit. And so I think there's no crystal ball. We get that. But you could do the best that you can to try to talk to as many people as you can. Talk to people about their experiences. And because the more I could talk all day because I talk to people all day about stuff like this and what their experiences are. The more people you can talk to about their experiences, I think is going to inform you and what you're going to be able to sort of know and go into when you're making a decision. Again, you want to think about more than I need to leave now. If you're making a decision because my lease is up, I need to leave, and there's a sign out that says only 2 left, going fast. That's not the best way to make a decision. You really, really want to be thoughtful, and I think the way to be thoughtful is to start early and go through all the steps that we've talked about today. So we will switch it to the next slides, and I think it's going to be questions. There you go.
We've got a couple of questions in the chat, and I'm monitoring the chat. If you guys are on and want to just pop them in, we will divide them out to the team here. Question number 1, regarding condo inspections. My daughter's realtor told us the inspection only covers the inside of the condo unit, does not extend to items such as building structure, integrity, roof, basement. Is that correct? Please discuss.
I can take that question. I think the inspection covers whatever you pay the inspector to inspect. So I think you want an inspector who's willing to take a look at the building because, if there are 10 units, you're going to be 10% responsible for the envelope of the building. So if you can't get a good sense of what the building quality is through the condo docs, then it's worth investing in an inspector that's comfortable at least doing a visual inspection of the exterior, the hallways. If there are common elements like a hot water heater and things like that, they should be qualified to take a look at those things for an additional fee.
Awesome. The next question is the type of property that people choose to purchase will help determine whether we sell or rent in a few years. Talk a little bit about that and what we should consider in buying a property if we move out of the city in 2 to 3 years.
Steph, do you want to take that one?
I was going to say, that's a good question. I can help with that. I think bottom line, and we work a lot on the Nest side with owners who come to us and want to know kind of what they can get for their property. And that tends to be the number one question is, what can I get in rent for my property? So as you're purchasing and as you're going down this path, your realtor for the sale should be able to give you some comps for what that property would rent for. And looking at that and then looking at the market would be really helpful. We try to be very transparent when we work with owners in terms of what that price range is going to be to get the property rented and to get someone in the door. So you want to take how much your mortgage is with all those other factors on top and compare it to what the market can bear. And there's a lot of variables in that, and the market's going to go up and down. Obviously, right now is an unprecedented time for some would say. So I would say kind of looking at what your expenses are going to be and then comparing them to what the market is a good place to start in terms of what you can afford and what would be reasonable. But you know, everything from a studio to, as Lisa and everyone had mentioned, houses, they will rent, but you just want to make sure that it's going to rent for something that makes sense for you and what you're paying. And one of the slides under condo, it stated it will devalue throughout the years. Does that mean renovations or property price?
Actually, it's depreciation. So maybe I didn't use the best word there, but if it's placed into service as a rental, so anything, whether it's a house or a condo, if you're renting that property out, the tax code requires that you take a depreciation of that asset over a period of 28.5 years. You know, whether the asset actually does decline in value is in some ways up to you and the marketplace, but for federal government taxation purposes, they're assuming that it will decline in value over time, not the land, but the actual physical asset. And so there can be tax benefits to owning a property in that respect, and then using it as a rental. It doesn't mean that you won't see appreciation in condos, but I will say that if you look at condos, co-ops alongside houses, condos and co-ops typically won't appreciate in value the same way that houses will. And it is not, it should not be a given that they increase in value at all. In fact, there will be times, and there have been times when values of properties have declined. It's not a given, but there's always that chance, and something to keep in mind. You won't see the same appreciation of condos unless you get lucky and you buy in a market or an area where things just change, you know, all of a sudden, and you find yourself next to the, you know, the new Amazon building, and your condo is suddenly really valuable.
One question from the pre-questionnaire was, how do you get pre-approved?
Ask your network and community if folks have a lender they really liked working with. And that's the first place to start. And there are a ton of great lenders, and there are some that are less great. So you want to get one that you know is going to be a good partner. And what do you like when you work with anybody? You want someone that's responsive, someone that's easy to talk with, and someone that can walk you through the questions that you have and take their time and be a good partner in the home buying journey. And then someone who's going to be able to help you navigate the lending process. Keep in mind, they will ask for information that, you know, a volume of information that you never thought was possible. It is an arduous and sort of very time consuming kind of administrative burden for people to get all the things that they need ready for the home buying journey. Your mortgage lender is going to ask for taxes, leases, proof of income for several years. If you've moved, they're going to want to have all of the addresses that you've got. If you're getting money from family, they're going to need letters stating that. They're going to want a list of all of your assets. They're going to want credit scores. They're going to want to check into things that maybe blips on your credit score. So those are all things that you can start now. If you're getting statements in the mail for, you know, credit cards, or if you're seeing those end of year statements, like, go ahead and just tuck them into a folder or a Dropbox folder and just start keeping those things handy so that, you know, you're not feeling this crushing wave of requirements that they're asking you. And also keep in mind, there's a lot of last minute transactional details they try and sort out. So you may think that you're set and ready to go to closing, and then 24 hours ahead of time, they're asking for 15 more documents. That's normal. It doesn't mean that your deal isn't a good one. It just means that that's kind of underwriting is the term for the team that reviews your application to determine whether you're creditworthy enough and should be approved for that loan. The mortgage broker is basically your partner. They package your file, they send it to underwriting, and the underwriters decide whether or not they're going to actually advance that to closing, meaning they're going to want to approve that loan. And so underwriting, once they start digging through all the details of your loan application, will come back with other questions. So that's a pretty typical process. But I always think that, the recommendation you get from people that you care about and trust will typically net a good recommendation for a mortgage broker.
Absolutely. And Lisa, you had said before, when you're building your team, if you are not working well with someone or you don't want to continue down that path, there's a lot of people who do this work. You can switch realtors, you can get a different lender. So at any point in time, if you're like, this isn't really the relationship that I want, don't be scared to move it. Because as Lisa mentioned, you're going to be working with these people for a lot of information, and it's a pretty tough process. So making sure that you feel comfortable with your team is important. Are reserve studies common? An estimate of what might be percentage of condos that will have them?
Jason, do you want to tackle this one?
Absolutely. And Chelsea, jump in if I'm incorrect here. I'm not aware of any requirement within the DC Condo Act that specifically requires DC condos to have them. So it's kind of a hodgepodge. I wouldn't necessarily put it on, give you an exact percentage. I will tell you that my professional judgment is that if you are looking at a property that does not have a reserve study, you may want to consider alternatives. The reason being is that the purpose of the reserve study, as Pavan was alluding to before, is to forecast the end of life for major building systems, your elevator, for example, as well as the physical envelope of the property, so the roof replacement. That's going to navigate the board of directors and the decisions that they make come the budget approval time regarding how much money they should have or how much money they need to raise in order to meet those expenses that are coming down the line. So certainly it is our professional recommendation on the roof side that all of our clients obtain a level 1 study and continue level 2 studies. Level 1 is the entry baseline calculation of everything, more of a detailed investigation, followed up by what are called level 2s, where they're coming back out to the property and recalculating what they had estimated before, and do those in 5-year increments. So biggest takeaway is that it's not required. I'd say it's a bit of a hodgepodge. Certainly condos that are much more complex and have much more building systems, typically I find it's easier to convince them to get those reserve studies. But I would certainly say buyer beware if you have an association that does not have a reserve study. And I can definitively say that essentially you're going in blind in terms of what's the true condition of the property and what is the financing necessary in order to meet the replacements that are coming down the line within, a 5 to 10 year window.
And just to add to what Jason said, it's important, having a reserve study isn't the only check mark, right? That we would recommend, is that making sure that there's a plan in place to address all those things. And I know he mentioned that, but it's critically important that the reserve document isn't just there to say it's there. It's more of a roadmap for budgeting purposes and saving, as well as tackling those large infrastructure things. So if you're reviewing a resale package and all they've got is the reserve study with no mention about how they're going to pay for all that stuff, then ask the question. It doesn't mean they haven't planned, but make sure to have your agent ask those questions and try to get some clarity on how the management company and or the board of directors is addressing that reserve study.
Awesome. Next one is, I know interest rates are low at the moment, but what's considered a good interest rate, assuming good credit and 20% down?
I'm sorry, can you repeat that one more time about the percentage down?
I know interest rates are low at the moment. What's considered a good interest rate, assuming good credit and 20% down?
Right. You'll be south of 3%. So maybe in like 2.75. It depends on the property. You're going to have higher rates for condos and co-ops. You're going to have more favorable rates for houses, and 20% down is obviously with a 760 plus credit score is typically going to set you up and position you for the most competitive rate. And in that case, it's not a bad idea to shop around a little bit if you know that your application is really strong, to see if you can find a lender that gives you a really very competitive mortgage rate. You can typically lock those rates in. Some lenders will, for a fee, they will float your rate. And that means what they'll do is they'll agree to, if rates go down farther than where they may sit, let's say that the feds adjust things and we're looking at the average floor of a mortgage rate at 3%. and you find something that you want and you have to lock in a rate in order to qualify for that mortgage, but you're worried that rates may go down, talk to that lender about whether you have the option of paying a fee to float your rate down. So in other words, if it goes down, 25% to 275, then you can take advantage of that, because that can make a difference in terms of your monthly mortgage payment and make it worth it to pay that fee.
This is kind of in the same vein. What are some problems that banks and mortgage lenders might have with condo association documents? What should buyers look for in the documents that might be red flags? Pavan, you're laughing, so I'm upset.
No, Chelsea's going to take this one because we were just talking about this. That's why I was laughing.
Yeah, that's a really great question, and I appreciate that. Whoever asked that, you're a smart buyer. So lenders and banks are looking at the budget, the approved budget, to make sure that it covers all the basic operating expenses, and that at the end of the day, you're not in the red. They're also looking to make sure that a portion is going into the reserve account every year and is budgeted accordingly. The minimum that most lenders will accept is 10% of income. So if you have $100,000 worth of assessments coming in, they want to see at least 10,000 going into the reserve account, which is the rainy day account. If they don't see that, they're going to push back and say, what's going on? Something's happening here. They're also looking at delinquency rates. Before, last year at this time, properties with, decent number of delinquencies were still getting approved with conventional loan products and even FHA approved backed products without an issue. But now lenders are much more sensitive to communities that have high delinquency rates, meaning, 10% or more of unit owners that are behind over 90 days is going to be potentially a red flag. And that would be reported on in the resale certificate. And oftentimes it can be explained away if owners are on payment plans and the bank is informed of that. They'll often, check that off the list and move it ahead. But at the end of the day, they need to protect their investment. And a building that has high delinquency rates is seen as not necessarily a strong investment, because there might be a need for special assessments or emergency funds to repair things because they haven't been able to meet their operating obligations. The other thing that lenders are looking at is usage restrictions and even bylaw amendments about how spaces can be used. So some of our communities, and I know some in the city, have owners have to live in the space before they can rent. Some lenders are not keen on that. Some could care less. They're also really interested in making sure that the insurance is where it needs to be. Lenders are getting even more particular with the insurance requirements for the master policy, and we're seeing an increase in having to get more coverage. And it's all within the realm of normal, but that isn't a cost to the association that they can choose not to go ahead with because it's not required. It's just recommended by a lender or two, or FHA backed loans, including Fannie and Freddie backed loans. So it can pose some problems with the loan product you're using, but there's often ways to work around it. And Jason, is there anything else that you would point out from your experience as well?
Chelsea, I'd be laughing with Pavan too, because I didn't mention this to you guys, but I have a similar situation that's going on at one of our condos right now about insurance levels and coverage requirements to meet the underwriting standards that the buyers locked into. The only thing I would say is that you got to build in time. And for people who are making that jump from being renters to owners inside of a condominium or inside of any homeowners association, the important takeaway is that the timeline that your underwriter may have and you may have with the the seller to get to the table may not be the same timeline the homeowners association has. And it's important to understand that these are bureaucratic systems. They are volunteers. Management companies only have so much authority to act independently to move business. And there will be times when we are checkmated by our limitations and we need to get guidance from the board. And that's going to require some time to explain to them the issue, explain to them the action that they need to take, and then get that approval. So it's important as you're going through the process, anything that you can do upfront for yourself as in terms of qualifications, understanding what you're going to need from the lender, being savvy in terms of the condos that you're looking at, and really diving into those resale packages will hopefully save you a lot of headache in that mad dash to get to the table so that the seller can move on and you can move into your dream home.
Awesome. We're right on time. Really good questions from everyone.
Yes, we're going to make this available to folks and send it out. We had a great turnout, and we're always really grateful for the time you give us to talk about things we love, which is property. I hope everybody enjoys their February and is looking forward to their 2021. And thank you again for joining us. We will see you in the internet world. Join us on our Facebook pages and touch base with us when you can.